What if you can buy or sell a home without the bank? Today, we're diving into seller financing, how to structure deals, avoid pitfalls, and create win-win opportunities in real estate. We'll talk about how to find owner finance deals, what the pitch looks like to the seller, benefits to the seller of doing owner financing. We'll talk about how the seller secures their position just like a bank would, talk about tax benefits, and then we'll even talk about like true seller finance deals and a little bit about subject to help us with that. We got Tanner Litchfield. He's a realtor / investor out of Utah. Welcome to the podcast. How are you?
Great, brother. Thanks for having me on.
It's interesting. It sounds like the crowd is going pretty wild already, just right off the bat. Sounds like everybody's pretty excited. Cool. So let's jump right into it. Like, okay, what is owner financing? And it's interesting because I have an owner financing deal. And before I got that, I didn't realize how much simpler they are to have the owner finance it for you versus going through a bank. But I think a lot of people don't know about it. So what is seller financing? And then how do you find owner financing deals as well too?
Yeah, great question. Yeah, a lot of people assume that there's a lot more into it because it sounds like a foreign concept, but I do both traditional and seller financing. Seller financing is always easier for me. And I'll clarify that true seller financing. When I'm talking about seller financing, it means there's no lien. It is own free and clear. And so to break that down into elementary, they have the house paid off. They don't owe anything on it. And when that happens, the seller can be your bank, right? So you're negotiating with them directly on all the terms, just like a bank would. So usually in a traditional deal, if you're negotiating, it's typically just purchase price. There might be some deadlines here and there, but there's not a lot of wiggle room in terms of what you can negotiate on a deal. Versus seller financing, there's the 5 levers, the most important ones that I talk about, which is the purchase price, the down payment, the balloon payment when it's due, the lump sum is due, interest rate, and then amortization. Amortization can be interest only, it can be principal only, or it can be the 30-year AM, like the banks typically do. But so that's the simple breakdown. You go to someone who owns their house free and clear, and you get to negotiate all the terms with them. They get to act as your bank. There's tons of benefits for them, great benefits for you, and you get to wear that creative hat to find the win-win.
I love it. Now, if it wasn't paid off, but they own a balance, you could still do it, but your down payment would have to be minimum that balance that they owe so that it could be a true seller finance deal. Or if not, it would lead into that subject to situation. Well, we'll get into it at the towards the end of this. But basically, you could find somebody that owns a balance, but let's say their balance is like 200. That just means your down payment to make it a true owner finance would have to be a minimum of that amount unless you go the subject to route, basically.
Exactly. Or they bring them the funds from their side.
Yeah.
So either one.
Got it. Fantastic. Okay, good. Now, we talked about the 5 different levers, or let's go back. So how do you find these? Are you just going direct looking for owners that owe very little money on their mortgage or have their properties paid off? And are you going direct to seller, or are you finding most of these deals on the MLS?
Yeah, so I've done direct to seller. I've done the postcards, managed cold callers, etc. Right now, in the nature of today's landscape, I am all on the MLS. There's enough motivation there that it's kept us busy. So I'm not saying I'm never direct to seller, but in today's landscape, it's all like MLS.
It's interesting because a lot of investors think that they have to go direct to seller, but there's actually a lot of opportunities on the MLS. What are the benefits of going on the MLS versus all the other things? And there's so many additional moving parts that you have to manage going direct to owner, and like a lot of lead follow-up, a lot of things. Can you talk about the different strategies and the benefits of using one versus the other?
Of course, yeah. And I've been through the thick of both of them. So I feel like direct to seller, there's a lot of overhead. there's, like you said, there's a lot of touch points, right? You're following up. It's, I think 11 times is the average, to where you get average, get a deal done, right? 11 touch points. Um, so for me, the direct to seller method can be amazing. For my personality type, there's a ton of overhead. And when there's a ton of overhead, it makes you feel like you have to sell every deal versus buy. And for me, my long-term goal is always to like gain financial
Hold.
freedom for myself. Exactly. I have the whole mentality, right? So when you have all this overhead and you just spent 15 grand in a month to find one deal, well, when you're looking at that deal, you're not like, oh, I want to take this. It's like, oh gosh, I got to pay off my marketing and then the next, right? So that's been I know other people are better at that than me. But the direct to seller method, there's a much better ways to do it. I haven't mastered it, in my opinion. Whereas on market, you're pretty much a follow-up manager, and you still have to sift through a lot of deals, but you're talking to a warm lead from the beginning. And that fits my personality type a lot better. I'm not getting cussed out 400 times a month just to get a deal, right? Like I'm talking to someone that wants to sell. And if we can curate that win-win solution, great. If not, there's no emotion behind it, I'm on to the next one.
So
So,
what does your criteria look like when you're looking on the MLS?
yeah. So right now, a lot of what we're doing is we find people that are actually advertising seller financing and negotiating those to where they make sense. So we're not trying to sell seller financing to them. We're just negotiating
Smart.
those deals to where they make sense, right? So that's a bottleneck of however many deals are advertising for it, and so we kind of have to push geographically to grow. But that's what we've done, and it's worked really well. And we throwing content out there and kind of building a local personal brand. A lot of agents are bringing me the deals before they're advertised because they don't know how to go about
Structure
the
it.
seller finance process. Exactly. So we're getting a lot of deals done that way too. But I'd say like our buy box right now, true seller financing is usually one of the first questions we ask is like, is this owned free and clear? And then I have a calculator that we built out that's just like a cash on cash calculator that throws like an appreciation metric in there for an ROI. Utah, where we're at, is a very solid appreciation market. So when you pair even a 5% cash on cash with even a 3% appreciation, it's spitting out a 25-30% return, right? So as long as your down payment, I could speak on this forever because I freaking love it, but I'll try and go back to the simple terms. If it's free and clear, that's a big metric for us. The balloon payment is probably the biggest one after that. If they want a 2-year balloon, it just doesn't make sense for my investor pool, for myself. We're bare minimum 5% with really good, or sorry, bare minimum 5-year balloon with really good terms, but we try and be 7 years or longer. And that just gives us room for the market to do its thing, rents to increase, equity to grow, makes our refinance or our exit strategy much easier. And then, of course, interest rate is a big factor. Um, if they'll go interest only or not, interest only gives us more cash flow. We're not paying as much principal down. There's a lot of different nuances, but it really comes down to those levers that we can push and pull. And if the seller wants 2 of them, that gives us a great basis. Okay, they need these 2. Let's see if we can push and pull those 3 other ones in our calculator to see if it makes sense for us. If not, we move on.
Got it. Okay. So I think it's very smart to just go after the ones that are already advertising seller financing as opposed to everything else. It probably reduces the amount of deals that you have to sift through, but then it comes down to negotiating better terms, and it makes sense to go out a little further because now it opens up the deal flow as well too, versus in a small market, maybe you run into a lot less deals with that. Let's talk about the 5 different levers. So when you're negotiating owner financing, and it's interesting because I get this question a lot, like, how do I negotiate owner financing? And it's like, well, look, it's the same thing as getting bank financing. The only thing is that you're dealing directly with the seller. So there's more flexibility on the different terms. What do you guys typically look for in terms of down payment? Are you guys trying to buy with less money down, like 3% down, 10%, 20%, 30%, 50%? What does the ideal look like for you in terms of down payment?
Yeah, great question. We try and so with being on market, you got to pay commissions, right? So, like the 3% doesn't usually happen in my world, because commissions need to be paid out for myself if I'm finding it for someone else and for the listing agent. So we're typically right around like 8 to 12% down. If it's a really good deal, we'll go like 15 to 18% down. It's rare that it's 20% or more. So that's usually what I look at. Now, this is another huge benefit for buyers here. With a lot of the clientele that I work with, they need to buy for taxes, right? So cost segregation to them is like that buzzword. And if you're putting less down, your cost segregation, your tax savings go a lot further per
Oh
dollar
yeah.
spent. So if we can do 10% down instead of 25% down on a traditional investment loan, their tax savings are double,
Yeah.
right?
Yeah. And it's interesting because when I started buying real estate, I didn't understand tax savings and I didn't understand the powers of depreciation, which those are huge. And the benefit is if you're buying an investment property, you're probably putting minimum 20, 25% down. On owner financing, you can buy with 8, 10. I bought an apartment building with like 3.5% down, basically,
That's amazing.
which was amazing, you know? Okay, so basically that kind of gives us a range. Now, for the viewers that don't know what a balloon payment is, can you explain that to them? Because I think most people understand down payment, but some people may not understand, like, okay, what is a balloon payment and how does this applicable to owner financing?
Of course. Yeah. So the easiest way to describe it, a bank has a 30-year amortization schedule, right? So they're planning on you paying that off in 30 years. Well, if you're going directly to a seller, they don't want to wait a third of their life to get all their money back from this
Yeah.
investment. So typically they want it sooner than that. And so where the balloon payment is that's when you have to pay off the seller. Um, and a lot of people assume, well, how am I going to pay $400,000 on a note to them? It's the same concept. Like you can refinance and have the bank pay them, or you can sell that property. The new buyer can pay them off. There's different exit strategies that you can fulfill there. And that's where the risk really, like, especially for true seller financing, if you have a 2-year, 3-year balloon, you're forced into your exit strategy way too soon, in my opinion. So having a longer balloon always limits your risk.
Yeah, and it may not even give it enough time to really capture the real benefits of owner financing because short term, the market can fluctuate tremendously. A year or 2 years, market can go up, market could go down. It could put you in a bad position. Now, I think where people get confused is the difference between amortization and balloon, basically. So in the example that you just gave is the bank does 30-year financing. That means it's due in 30 years and the amortization is also 30 years basically. Talk about how you can play with those two different levers to maybe make the payment a little bit better or give you a little bit more time with the balloon. How do those two levers kind of go hand in hand?
Yeah, great question. So when I talk about the 5 levers, I use amortization just as an example of how much principal versus interest I'm paying. So we'll use amortization, that the first word. That's what banks use. That's what a lot of people are comfortable, or that's what's most common, right? An amortization is an equation that shows how much interest is being paid out over the life of the loan. And in a 30-year mortgage, a 30-year amortization, it stacks the interest up front, right? And so at the beginning of your 30-year play, it's going to be mostly interest heavy. At the end of that 30 years, if you hold on to it, which most people don't, and the banks know that, right? So they're getting a lot of interest up front. At the end of that 30-year, it's going to be mostly principal. And so when you sell in 7 years, you don't really get to the part that you are paying a lot of principal and that portion. And so when I talk about that as a lever, all I'm talking about is how much interest, the ratio of interest to principal. Now, when we're dealing with owner financing, seller financing, there's no rules in that. You're not working with a bank, right? So I've had deals where I'm like, okay, 25% of my monthly payment is going to be interest, 75% is going to be principal, and I'm going to hold that same ratio for 10 years. There's no rules. You can do a step up where at the beginning it's 25% interest, and at the there's so much that you can play with there. It can be interest only, which I actually do a lot of. If a seller is really keen on their return on their equity because they want to match a CD, they want to match a bond, I can give them that 4%, 4.5% interest rate. But if I go interest only in an expensive market like Utah, it still allows me to cash flow. And then I'm banking on the market and appreciation, right? So,
Yeah, 100%. So there's a couple different options with this amortization and balloon payment. Interest only, which is very easy to calculate. How would you calculate the interest only payment? It's so easy, basically, to
yeah. So
calculate.
and that's probably another reason why I use interest only a lot, because I can use my phone to do it, right? So I literally go in my phone and I'll do the, let's do one
The
right
loan
quick.
amount. Yeah.
Yeah. So if it's a $500,000 loan, then I'm timesing it by 0.05. That's the interest rate, 5%, 0.05. That gives me 25 grand a year. Then you divide that by 12, 2,083 is my monthly payment. So it's
So
super easy.
easy.
Yeah,
It's so easy. And that's what I love about interest only payments as well, too, that literally you can calculate the interest only payment. Then you just calculate your property taxes, your insurance, and you have your total payment already there. And you can do it all without this fancy amortization schedule. So that's one of the ways that you can structure it. The other way is just traditional amortization. So would you agree with this, that the longer the amortization, the lower the monthly payment? The shorter the amortization, the higher the monthly payment, typically, unless you start playing with the different factors, basically, that we were talking about just a few moments ago.
you're exactly right. Yeah.
So you can make the payment higher or lower just depending on how many years you're amortizing it for. And then even if you do a 50-year amortization, you can make it due still in 5. You're just playing with the monthly payment, basically, in that case. Now,
Exactly.
you touched on something that I've never done and I've never played with. You said something about I can play with the amount that goes into the principal and the amount that goes into interest, even at the very beginning of the loan. Tell us more about that.
Yeah. So this is something that it's super, super fun. Just when you try and ignore the bank, it's like if I was just meeting with someone in 1700 and it was on a handshake, I can get as flexible as I want to buy their cave or whatever they're living in, right?
Their cave.
So
That's so funny.
that's what I try and have in my mind. So what I'll do is, I mean, especially this was before Chat GPT that I started doing this, but with Chat now, I'm sure you could do it so easy. But I'll literally go in Google Sheets and I'll say, okay, here's my May payment, here's my June, July, August, September. You can spell it all out. It doesn't take long to do that, 12 times to the amount of years, right? So it might be a few pages, but now you're just putting in, here's how much I'm putting in interest, here's how much I'm putting in principal on 2 different columns, here's the balance due after. And when you have equations in there, it's not hard. It's not like you're inputting these manually. And then I'm signing that payment schedule. That's all I call it. I'm signing that payment schedule with my contract, and I'm sending it to title. And we have middlemen, escrow
Like a servicing
specialists.
company.
Yeah, it's
Yeah.
a servicing company. We call them escrow specialists, is the Utah company. And then you're just giving that schedule to your servicer, and like ours is okay with it. Hopefully the servicing company that you guys deal with is okay with it too, but it just gives complete flexibility. You can have it step up in 3 years, 1 year, whatever it might be.
So how would you, like, let's say the owner wants a 5% interest rate. How would you play with that in the amount that goes into the principal versus the amount that goes into the interest?
So that's you are throwing out the interest rate completely. At that when you're doing a manual payment schedule, I am throwing out the interest rate completely.
It's just basically like, hey, look, this is a total payment. From this total payment, we have $1,500 going into the principal and $500 going into the interest every single month, basically.
Yeah,
So, if you do the numbers, you might be at a 2% or a 1% interest because of the way that you're amortizing it. But people may
exactly.
look at that $500 interest payment and be like, oh, I'm getting $500 a month on my money, not knowing how the typical structure is that it's typically higher interest versus principal. Can you go over an example of a way that you structure that creatively and how that ended up playing out?
Yeah, so and that's exactly right. Like you can find an interest rate per this, and I'm sure you could have a, but like the concept is like you don't need that interest rate, and you're just presenting numbers. You're just like, hey, for the first 3 years, I'm going to put 25% into interest, 75. But so I mean, there was a deal where I did on a fourplex in Salt Lake where it was like the first 2 years, it was a pretty much a 5% interest rate, right? Whatever that came out to be. I was paying a lot of interest up front. Now, and I stepped up into after 3 years, it moved to like 75% of my payment was going towards principal. And so a lot of times what I
Gotcha.
do is it goes 25% principal at the beginning, then it grows to 50%, then 75%. And that's usually over, I do 2 year, 3 year increments on each one of those steps. So it ends up being, let's say, a 6 year balloon. And at the last 2 years, I'm putting 75% towards principal, which on a 30-year AM, you're waiting 20 years to get to that point, right? I don't know the exact year date, but you're waiting a really long time where you're putting a good chunk of your monthly into principal.
Yeah, and that's the cool thing that you can get creative, and that's something that I've never even played around with. I've played around with the, hey, how much do you want your monthly payment to be, and almost like all of it goes to the principal. But I never
Yeah.
thought about playing around with the amortization schedule. But it's also like it gives you more levers to be able to give the seller what they want and them giving you what you need as well too to be able to make that happen. Okay, great. I think that's fantastic insight right there. So we talked about the down payment. We talked about a balloon payment. We talked about the amortization, the interest rate. We've talked about that as well too. What type of interest rate are you guys looking for on these deals if you're not going with one of those creative amortization deals?
Yeah. So usually, like, I haven't done a deal that's over 5%. And if it's 5%, typically it's interest only. Just if you want to have any cash flow here in Utah or break even, 5% is usually like the breaking point right now on an interest only. But I'd say 80% of my deals are between a 3% interest rate and 4.5.
And 4.5. Perfect. And that's in today's marketplace, which is phenomenal. Okay, so let's talk about the pitch. They're open to the owner financing. How are you pitching this, especially if it's a 75% principal to 25% of interest? Do you get pushback on that? And how does that typically work?
Yeah, of course. Like you always get pushback, right? And that's what you understand as an investor, and I understand as an investor. You're dealing with 100 no's to get to that one yes. So, and I wouldn't say I bring up that creative amortization or payment structure that I was talking about every time. I try and listen to their needs first, and then I bring my needs second. And I think that's the important thing here is in my conversation, I'd say it's less of a pitch, especially when it's a warm lead like this that's trying to sell their house. It's like, hey, what's most important to your client? If I can mix my needs in with that and find a win-win, cool, let's do it. If not, I am very keen on like removing the emotion and going to the next deal. I think new investors, they find someone that's open to seller financing, or they find a seller that's somewhat motivated and they spend so much energy on one deal versus using that energy to find the next deal. And that'd be my 2 cents. But the main benefits of a seller, just to break it down, are we're usually purchase price is one of the least important factors if we have a long enough balloon. And so we can typically give them their purchase price in exchange for better terms. And a lot of sellers are emotional about their purchase price. And so we hit on that part. And then I'd say also is the tax savings for the seller. If it's owned free and clear and they can spread out their capital gains, it can be monumental for them. So we focus usually on those two things.
Okay. So let's jump right into the tax savings. A lot of people don't realize that there's tax incentives whenever you're doing owner financing deals. Are most of the deals that you're doing owner occupied or investment properties? And then how do those two vary in terms of tax savings for the owner?
Yeah, most of what I'm dealing with is investment
Fantastic.
deals, right?
Yeah.
And so if on the tax savings, if it's an investment, it meets the requirement for capital gains. I don't want to act as a CPA and pretend I know more than I do. But if it does, if they have a big capital gains hit, I mean, think about it. If they bought it 25 years ago for $100,000 and it's now worth $600,000, they're going to have a 6-figure capital gains hit a lot of times. And if we can spread that out for them in terms of owner finance, the IRS views it as an installment sale. And so it's nothing sketchy with the IRS. Like, they have it in their paperwork. It's a perfectly fine loophole. The IRS views it as an installment sale. And what that does is it spreads that capital gains. And the cool part about this is if you can spread a big part of that hit to where they're in a different bracket, it can be great, right? Like if they're at a certain tax bracket today because they're working, they're at the heat of their career, but in 15 years when that balloon hits, or in 10 years they retire, they're in a complete different tax bracket than they were. So there can be significant tax savings as well as spreading it out.
Yeah. So basically, if you receive a very large lump sum year one, you're basically at a much higher tax bracket because you're receiving all of it year one. If you spread it out, you're more than likely on a lower tax bracket, which means you're paying a lot less percentage per the lump sum basically per year, which is phenomenal. Now, how do most of the sellers typically have questions about this? And if so, is there an easy way to explain that to them? Like, is there a calculator that's like, hey, look, like if you net 800,000 year one and you bought for $17,000, this is potentially what the tax gain would be. But if you do owner financing for 10 years, collect 100,000 per year, then this is the tax savings. And you're also earning interest on the unpaid principal amount as well too. So how do you typically go about that? And is that common, not common, irrelevant?
Yeah, great question. So like for me, I don't dive into the tax side a lot. A lot of times, and this is where in the real estate investment world, a lot of times to find good deals, you are working with motivated sellers, desperate sellers, and you're capitalizing on that situation, right? And I like back when I was doing like the value add side, I was dealing with a lot of those people. You're providing a service to them that they need. And so I'm not shooting that down, but with seller finance, I'm almost dealing with the opposite. I'm working with people that are a lot more savvy in terms of investment world, because I mean, just think about one house that's owned free and clear at 500K. If their net worth is $500,000, that's a lot more than the typical American, right? So
Yeah.
And typically a lot of these people own multiple and they own free and clear, right? So that the clientele that I'm working, the sellers, they're not dumb. They usually have a CPA that they work with. And so I don't have to get too involved in the tax arena, luckily, because I'm not a pro whatsoever there. But that'd be my short answer there.
Got it. That makes sense. Now, here's a common question that I get sometimes whenever we're talking owner financing. It's like, well, like, what happens if they don't make the payment? How do you typically answer that?
Yeah, from a seller perspective.
Yeah.
So it's we talk about this. If the down payment is a decent amount, let's call it 15%, and they stop making payments on the 8th month, that's almost best case scenario for the seller because, again, they're acting as a bank. If I don't make my payments to the bank, they're going to take my house back. Same thing with the seller. If you don't make payments, they can act with their right with the contract and take that house back. Now you lose your 15% down payment. They can sell the house back. So really, the seller is in a good position. They can do a lot of things to qualify the buyer just as a bank would. It's not usually as lengthy, but just getting like a credit score and maybe some tax documents. I'd say 90% of them don't have like really any requirements. That down payment is enough skin in the game for them. But I'm dealing with one now where they want a couple year of tax documents and a credit score pull. So there is some due diligence that you can do.
It's interesting because when they ask me that question, I'll ask them a question right back. I'll be like, look, let's say you have a mortgage with a bank. What happens if you don't make the mortgage payment? And they're like, well, the bank will take the property back. I'm like, same exact thing. You're the
Exactly.
bank. So you
You
said
can
something
explain
that
these things. You
it's
can
so
explain
simple.
it
Like
way
it's,
simple than me. I gotta learn and not blabber my mouth. But you can explain it way simpler. I love that.
well, what was so crazy because I would get that question a lot. I'd be like, well, what happens if I don't make, what happens if they miss a monthly payment? And then I'm like, and then at one time I asked the seller, I'm like, well, what happens if you miss a monthly payment to a bank? And he's like, well, they'll foreclose on me. Same exact thing. And when I explained it that way, I saw the light bulb go on automatically, like very fast, and it was just became very simple after that. But here's what I was going to ask you: you made like a very key thing when I asked you how do you pitch it. You're like, well, I really just listen to their needs. What I find a lot of times when people are structuring deals is they're just thinking about themselves versus thinking about the other party. And when you're thinking about yourself and not thinking about what the other party needs, it limits your ability to be able to create a win-win situation. So I guess here would be the question because it makes me think of a scenario where a tenant was trying to buy a property from his landlord and he's like, well, I want to offer him 500. I'm like, have you asked him what he wants for it? Like, no. He's just thinking about what he wants to buy it for versus just asking him like, hey, what do you want to sell the property for? Same thing with owner financing. He's like, hey, what do you want to sell the property for? What type of down payment do you want? So what questions would you ask to be able to listen to their needs?
Yeah, great question. Especially in like the real estate agent world, a lot of times they will say, "Hey, just submit something, and we can do like that." Push back hard on that. My answer is always, "Hey, you know your seller much better than I do, um, and I don't want to send a blind offer because I have no idea what he wants." And I go back to those five levers. I'm like, there are so many different ways we can create a win-win here. Sending a random blast isn't going to be good for you or for me. And so I'll say, hey, you know your seller better than me. Out of those five levers, we'll call them like, what do you feel like is most important to your seller? And if they don't know, then they usually try and figure that out. So I just try and get a priority list um, from them. And if it's price and down payment, which a lot of times it is, they need their down payment for this, that, and the other. And if it's they absolutely need a 50% down payment, I move on, right? Like I don't spend too much more time on that. You can ask specific questions of like, I will always say, I don't try and like pitch them why they should take 10% down. All I say, if it's listed as, hey, I would probably be more around 15, 10% down in that ballpark. Is it still worth exploring? That's like my tagline I use a lot. Is it still worth exploring? And if they say probably not, I move on. If they say it could be, cool. Now we're in the ballpark and we can work with that.
Yeah, which is important. So you're basically going back to the five levers, be like, hey, how much down payment? Like, when would they want to be paid off? Basically, like 5 years, 10 years. How long do you think they'd be willing to finance? Hey, do they care if it's interest or principal and interest? And then, or do they want principal and interest? Now, one thing that we didn't cover is sometimes, like for tax purposes for the seller, it it may be easier to collect interest only, but then you have a huge balloon payment. So so it may be better tax wise to structure maybe principal and interest because you're paying down some of the principal. Because I think tax wise, what people don't realize is you're getting taxed on the capital gains based on the principal that you receive that year, basically. The interest gets taxed differently, but the principal gets taxed at the capital gain amount, basically. So that's what you want to spread, the principal and interest. So just a little distinction for people to kind of keep in mind. Now, I wanted to ask you, are you going after properties that have been sitting on the MLS for some time, or are you going after the new listings aside from the criteria that they're open to owner financing? And are you finding more success in one versus the other?
Yeah, I'd say like our number one requirement is just if it's advertising seller finance or not. Like I rarely look at days on market, um, because there's a lot of times where agents will change if they're not selling for 70 days, then they'll throw seller financing in the keywords, right, or in the terms. So I'd say like we are almost entirely focused on those keywords, but we still do. We have alerts set for new listings that have these keywords in. So, in my insight, like from being in the investment world for 8 years, I mean, you've probably been in it much longer than me, but I mean, you hear all the time. It's like you either want to be first or last. Um, if you're first, then you can get it while it's hot, and if you're last, like they've run out of a lot of options, and now they're a little bit more flexible.
We talked about like, okay, so there's true owner financing and then there's hybrids to the owner financing situation. Like one of the hybrids I could think of is where, let's say you want 100% financing and you get bank financing in first position and then owner financing in second position. Have you ever done that? And then another hybrid could be you're taking over the owner's loan and then you're getting some owner financing in second position, and then you're obviously giving a down payment in some sort of case. What are your thoughts on these hybrid models of owner financing, and what are the pros and cons, and what do you typically prefer?
Yeah. So that first method of like first and second position, I don't dive into that too much. There's a lot of gray area there, and some people find a way to be above board in that gray area. But for me, in like thinking 20 years in the future, I just try
Simple.
and keep it stupid simple. So I don't do, I mean, people call it the Morby method. I know it's been around a lot longer than Pace Morby, but I do not dive into that right now. Like I feel like the residential lending world hates it. And I try and stay clear of that for various reasons. I know that commercial can be a little bit different. And so, um, yeah, I'm not speaking in that regard, just residential 4 units and below. As for the second option of hybrid, yes. And this is a good transition, I guess, of like where sub two enters my business is when I lost like 200 grand, it was 180 grand and 20 grand with attorney fees. So I lost 200 grand on a sub two deal. I learned so much about what I'd do differently. And I could speak on that loss for 40 minutes. So I'll save you that portion. But one of the biggest learning lessons is I wanted the seller, no matter what, if I did a sub two, I wanted them to have some skin in the game in terms of equity. So if I do a sub two deal now, I want them to be a partner with me versus getting all their equity pulled out. There's nothing stopping them from telling the
Wow.
bank, hey, I sold
That is
this 3 years
so
ago.
good. That is so good right there. Because if they have some skin in the game, they still have an incentive to continue with the deal. If they
Exactly.
don't have any skin in the game, it could basically go to the bank and say, hey, I sold the deal. I'm not the owner anymore, and call out that due on sale clause. So what is the due on sale clause, and can you explain that? And then I'd like to get more details on how the deal was structured, if you're open to it,
Of
so that
course.
our viewers can learn a little bit more as to like, okay, like the dangers of certain structures.
Yeah. So a due on sale clause is a clause in a bank's contract, right? And it's hundreds of pages, however long your bank contract, maybe not hundreds, but it's a lot of lingo that you probably don't read a lot, right? So the due on sale clause is in almost every single mortgage contract in today's day and age, and it gives a lot of stipulations on why a bank can accelerate this loan and call it due. It's not just sub two. There's a lot of reasons they can accelerate that loan, but in terms of this regard, on a subject to deal, you are transferring title without the bank's permission. And so you are 100% going against the bank's contract. So they say it's not illegal, but it is going against the bank's contract. The bank catches you transferring title, which AKA selling your property without them knowing. They can say, hey, this note is now due. And so if that note becomes due, you are pushed into your exit strategy much, much faster than you want or are prepared for. Now, this is where the nature of my deal gets super, super into the weeds. I did a deal when I talk about subject to, and one of the big learning lessons that I learned is one of the most important things you want to look out for is how big the servicer is that you're taking over. If you find a small servicing company, which let's say a small bank, or like a low income type program, which most states have, I should say every state has, they are tracking their loans much, much closer than, let's say,
More
a Mr. Cooper.
diligently. Yeah.
Exactly, right? Like those big servicing companies. So if you're going to do a subject to deal, make sure it's one of the big servicing companies. Don't do a small credit union or any of that nature. Um, this was my first creative deal that I lost everything on, right? And so mine was a low income type entity, which I had no idea. So it's probably karma that I got my teeth kicked in on this, because it literally was a program. This loan was a low income type program. Now, people always say, well, how do you know in the future? And that's where my next learning lesson is: make sure you have a title company that has your best interests. In Utah, we are a title state. Some states are attorney, some are both. Utah is primarily a title state. So whether it's an attorney that has your best interest or a title company that has your best interest, that is absolutely crucial when these deals get intricate like this. So I obviously didn't have a title company that cared about my best interests. And so they threw a piece of paper in the stack of 50 that I signed at closing that waived their what's it called?
Liability
Their
on it, their title
liability.
insurance, basically.
Exactly, right? So when you're signing 50 documents, you're not looking super close at the fine print. So that's what happened. Now, going back to it, there was a deed restriction in on this property that said that only owner occupants could live there because of the nature of this loan program. And so even if I tried to pay off this loan with like hard money, whatever it might be, I'm screwed either way, right? So my attorney at the time told me that I couldn't buy it at auction because I didn't meet the stipulations of low income, which I learned after the fact was BS. And I had talked to 3 attorneys at this time, and I think that's one of the biggest frustrations with me and subject to is all the gray areas of like, this is what we think happens, this is what we hope happens, but you never know the perfect answer, even if you're working with a real estate attorney that has 40 years of experience. So that's the frustrations on my end. Now, if you can get a super clean deal and you carry those risks and it doesn't have these deed restrictions, usually the worst case is they call it due and you get out of it, you find your exit strategy. One last note that I'll put on here. A lot of people say, okay, you can convert this to a contract for deed where you are giving ownership back to the original seller so that the bank says, oh, okay, you're fine now, right? Well, we tried doing that, and because I transferred ownership, I had equitable interest with this contract for deed, but I didn't have true ownership. Now, when it sold for bank at excess funds of 40 grand, guess who got the excess funds? Not me, because I gave up title. It went back to the
The
seller.
previous seller. Wow.
Yeah, which is a
That's
nightmare.
insane.
So,
Yeah.
anyways,
It's a good lesson though,
oh yeah, yeah,
Yeah.
expensive one, but I learned a
I,
ton
I,
from it.
I think the cool thing is you kept on moving, so we'll give you a round of applause for that. You kept
I appreciate it.
on chucking and kept moving. All right, so we talked about like different exit strategies as well too. And we've got other videos on subject too. If somebody wants to watch it, just go to our channel. We've got like very in-depth videos on subject too. I like the fact that, hey, look, the owner has some skin in the game because it kind of like keeps both of your incentives alive. We have one where the owner has like 180,000 in paper in carryback, which that means that, hey, look, like they still have an incentive to continue working with you because they're receiving monthly payments. It's funny, on one of them, I actually financed my commission into it. So I'm actually receiving monthly payments myself as well
I
too,
love
just to kind of make the deal work. Okay,
it.
but let's talk about the different exit strategies. So, to some people, 5 years is a short time to have a balloon payment. And if you have like five of them coming due, there's the risk of potentially interest rates going up, but there's also the risk of interest rates going down, or not the risk, the benefit of interest rates going down, which they're kind of trending in that direction. So what is your actual exit strategy? Is to refinance after the 5 years? Is it to go back to the owner and say, hey, look, like this has obviously been a great partnership so far. Are you willing to extend it another 5 or 10 years? Or is it to sell the properties and just take out the appreciation at that point? What are you typically doing at that point?
Yeah, for me specifically, everything that I buy, I intend on owning for 30
Holding it.
plus years, right? And that's
Love it.
just me. That's my personal strategy. So I'm only thinking refinance or renegotiating with the seller. Now, that's why another reason why I love working with free and clear properties is because it, like, if you're dealing with a 7 year arm with the bank, they tell you when it's due, and there's usually not a lot of negotiation
Flexibility.
there. So yeah, that's my intentions. And there's a lot of cool ways in true seller finance to bridge that gap of like, hey, you want 5 years, I want 10. Well, what if in 5 years, if it appraises at X, you're good. We'll pay you off, and we're good and dandy. But if it doesn't appraise, we get a 2 year extension. So I literally have a triplex that I own that has a stipulation in there. It's a 5 year balloon, an option to extend 2 years if the owner's not dead. Not dead or in hospice is the correct contract word. So
That's so
um,
amazing. I love
yeah,
that. It's interesting because I had one right now where the owner wanted to do owner financing. She's like, look, like I'm willing to do 10 years, but if I die, I'm going to give you 1 year after I die to basically settle it, basically. And she's like, well, look, just to let you know, I'm in perfect health condition right now at the moment. So I don't plan on dying in the next year or two, but obviously you don't know that. Um, Talk to us about like different stipulations. That was key, like because that was the first time that was brought up to me by a seller. Talk about different stipulations that could be added on there. One of them being obviously if I'm not dead or I'm not in hospice, a 2 years extension basically if it doesn't appraise at this price. Are there any other stipulations that you could think of that you've added or that you've heard of people adding that would help meet the needs of both clients? Because in this case, the client that I had, she's like, look, I have a clause in my trust that if I die, I want everything settled within 1 year, which is why if I die, it's due in 1 year, basically.
yeah, great question. So typically it's the balloon extensions based on appraisal or what, but I mean there's tons. You can get as creative as you want. Another common one that I see is like a prepayment penalty. which is common in like DSCR loans, debt service coverage ratio loans. And the reason, going back to like the taxes, right? Like these sellers, if you paid them off in a year, it can change their tax landscape completely, right? So sometimes sellers will throw in a prepayment penalty to have clearer expectations on when they'll be paid out. And if they are paid out early, they're getting a 3%, 5% penalty. And that can slide. Usually they do slide. It's like, okay, if you pay me off next year, it's a 5% or 3%. The year after that's 2, or a sliding scale right down to 0.
That's amazing. Good. Um, what are the sellers typically asking for whenever they're considering financing it to you? Because I look back at the deal that I got financed. He financed $4.3 million for me with no credit check and no proof of funds or nothing like that. So I'm looking back at it and I'm just like, wow, like that was like so easy. But it was a past client of mine. Obviously, we had a great working relationship already. But like, what are the sellers typically asking for? And that just so the viewer can see and be like, wow, like I can buy a property if I wanted to, like, and it could be a lot easier to qualify sometimes in the bank. But what are you typically seeing in that regards?
Yeah. So, I mean, most typical is nothing, which is wild. Similar to you, like most typical is the down payment is enough skin in the game for them to feel okay with it.
Yeah.
I'd say the next most common requirement is a proof of funds, which can be as simple as a screenshot of a bank account or a few bank accounts. We do that quite a bit, just to show some buyer qualification. And then I'd say the next most common is credit score. And a lot of times, like that's just a screenshot of your Experian. Like people think this is like a lot more official than it can be, but a lot of times it's just wild, wild west. Like there's no hard credit pull. Sometimes there is, and then I'd say the last most common is like tax returns, which is one of the deals I'm working on now. Is he's a CPA, the seller, and so he's a little bit more strict on buyer qualification, and he wants to run that himself.
Yeah, amazing. So I took a course on owner financing, and they made me aware of something that I think is worth sharing. He basically asked me a question. He said, look, when you're buying a car, what do most people negotiate? And he's like, well, they negotiate the price for the car. He's like, but where does the dealership make the most money? I'm like, huh? He's like, the finance department. He's like, the finance department is the department that nobody really understands. So they really don't understand all these different levers that you can play with and how you can do it. So he gave an example. He's like, look, here's an example of how you can structure a deal. He's like, look, you can ask for 0% for the first 5 years. And then after that, you can step it up to a 3%. And after that, like you can step it up to a 5 or a 7, whatever he wants. He's like, the key there, he's like that because it's 0% for the first 5 years, you pay down so much of the principal already that when you get to the higher rate, you're paying a higher rate on a much lower principal balance. And when he said that to me, I was like, man, like there's another level to this. And that's obviously the level that you've learned, which is like pretty great. Here's what I wanted to ask you. What is a note in a deed of trust, and how is the seller protected in a sense that, or how is the mortgage created, basically, is what I'm asking.
Yeah, great question. So, and that's where a lot of people assume seller finance is like a handshake deal with your uncle, but it's literally the same exact process as a bank, right? So, for us, it's a title company, so that's what I'm going to keep referencing. The note is the IOU. That's literally what you and the seller agree upon. I owe you this. Here are the terms of that deal. And like the title company drafts that up based on contract. And then the deed is the ownership part. Both of those are recorded. The title company records those simultaneously as a lien and then as an ownership change with the county. And it's official at that point. So it's notarized and everything.
I love it. Yeah, that to me was a game changer. When I learned the note in deed of trust, I was like, wow, this is like so simple. It's so easy. Now,
Yeah.
let me ask you this. Like if an owner is doing owner financing to an owner occupant, is it different than an investor? And are there more rules and regulations in that sense? So if you're an owner, you should be a little bit more careful. There's Dodd-Frank rules and different lending laws if you're doing it to an owner occupied versus an investor, basically. Any thoughts on that?
Yeah, so I haven't dove into that really at all. I have studied like Dodd-Frank recently and the stipulations there until this recent deal where even if it was owner occupant versus investors, and probably the reason is I've almost worked entirely with investors
Investors, yeah, which is
when
great.
it comes to owner financing. I work with a lot of a lot of like home buyers on the traditional space, but what I came to realize is if I'm searching 300 listings to find one that has decent terms, the chances that my client likes the color of paint and the ceiling height, etc., it just was like the worst spend per revenue stream in my business. So I shifted to divide those. If you're an investor, cool, let's go get owner finance. If you're a home buyer, let's stay in the traditional scene. But I mean, you'd know more about this than I do, but the seller in
I
this
think you're
recent,
being very humble when you say that. I think you know a lot.
I appreciate it, but and specifically with this Dodd-Frank, it can get really sticky, and I haven't studied it probably as much as I should have. But I know there's like interest rate requirements, and that can get sticky. But
Yeah.
in for this specific deal, the CPA seller that I was referencing, just to show kind of his risk on an owner occupant versus investor, he only required 25K down for an owner occupant, but he required double 50 grand down. This is just a townhome, so not a huge purchase price. It's 450,000, but his risk adjusted based on who lived there, right? So an owner occupant he felt like was much easier or much less risk, right? And he had a credit verification there in that process too. But that's really the only time where it's changed for me on an owner occupant versus investor. And that's probably because I'm dealing with a lot more with investors, so I don't run into owner occupants as much. But that's what the seller's requirements.
Now, let me ask you this. Like I've heard on different guests that they say don't ever bring up the interest rate. Just bring up what do you want your monthly payment to be in owner financing, basically. What are your thoughts on that?
Yeah, so I have a little bit different way of phrasing that. I say, does your seller care more about his return on his equity or his monthly payment? Because to me, those are two separate things. If it's a return on his equity, he's already thinking about the interest rate. Um, if it's a monthly payment, I can go principal only for all they care, right? I mean, usually
As
they
long
do
as they
care.
meet that monthly payment, basically, like, hey, look, my rent is $3,000 a month, or I'm going into assisted living and I need $6,000 a month. That's what's most important, which is a great question, basically, to ask.
Exactly. Yeah. So mine's a little bit different. I mean, maybe I could get more aggressive into that monthly payment world, but again, I'm just trying to feel out the seller's needs, and so I'll phrase it as such.
That's fantastic. Okay. Now, what is a servicing company, and do owner financing deals typically need a servicing company, or can they just be without a servicing company?
Yeah. So a servicing company is the person that facilitates you making the payment to the seller, right? Making sure it's in the right hands. When it's a subject to all inclusive deal, you should have a servicing company 10 out of 10 times because you, as the buyer, and I speak a lot from like the buyer perspective because that's a lot of the world I stay in. But like as the buyer, you definitely want a servicing company because you want to ensure that your payments are going to the bank, not to their pocket, and that they're not making those payments, right? And the servicing company provides that clarity for you. Now, when it's true seller finance, you, I still do a servicing company almost every time. Um, our servicing company is Stone Age and not as good as I'd like it to be. And so we are actually looking at moving a couple of our properties to direct payments because it's been super slow to get it's debiting my account on time, if not a little bit early, but it's getting to the seller's account a little late. And so there's been some drama every month there. But on the owner finance, how I view it is, if I can prove that I'm making the payment, I'm meeting my contract needs, and it's going directly to him. There's not really as much of a need for the middleman. So I think it's less of a big deal if it's true seller financing on a servicing company versus sub two.
Well, I even think like if you got a balloon payment and let's say you want to make a lump sum payment, it makes it easier to get a payoff basically like when the balloon payment is due. It also makes it so that like every year the owner receives that statement of how much of it was principal versus interest, and it makes it easier so on the one of the owner financing deals that I have, it was interest only for the first 5 years. We didn't have a servicing company. When we switched to principal and interest, that's when we decided to go with a servicing company, because at that point we knew that the taxes were going to be a lot different, and there's just going to be a lot more. And it was nice to see the principal balance going down every single month by how much it was going. Cool. Anything else that you think would be helpful as it relates to owner financing?
I feel like we've covered a lot of it. I think in simple terms, like the beauty of seller financing is you really can get creative as possible to find a win-win solution. And you can make that as simple as you want to. So yeah, I feel like we've touched on a lot of it. I've appreciated the conversation you having me on. So
yeah. So let's say somebody wants to go pro in owner financing and want to learn this. How would they get in touch with you?
I love it. I got to figure out how to use my controller better like you. So I post mostly on YouTube and Instagram. So I'm the Investor Tanner on both of those. I wouldn't call myself like a course guy by any means, but I've had so many people ask me about learning this seller finance world that I did create a little $500 course that's in my Instagram profile. So if you are like wanting further education, I don't really do one-on-one mentoring or anything like that, just because my time's in my business. But if you do want some like videos and some community to guide you through it, I do have that little plug. So, but there's tons of free content on my YouTube, so don't feel obligated there.
Love it. So I've enjoyed our conversation. I think that it's been extremely helpful. Obviously, we've covered a lot about owner financing the traditional way. If our viewers have enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. Once again, we had Tanner Litchfield and we talked about creative financing. Thank you, Tanner, for taking the time to be on the podcast. And to our viewers, until next time.